Now it's my pleasure to discuss these 4 papers in this session on small business lending. And I will say, first of all, these are 4 very interesting papers, both individually and collectively. Given the time constraint, however, I don't think I've got the time to do the sort of typical academic granular critique of each paper. So what I instead am going to do is focus sort of on the connectivity among these papers, look at some key findings on the changing role of community banks, and try and cast the findings in these papers in the context of the academic literature on the role of community banks. And also discuss the implications of these findings, including in particular the limitations on the conclusions that we can draw from them. And a lot of that discussion is going to be focused on what I see anyway as shortcomings in U.S. data on small business access to finance. And I'd also like to conclude by talking a little bit about a term that I use, lending channels, as possibly a paradigm in which we can look at these kinds of papers. So regarding the connections, all 4 papers directly or indirectly address the role of community banking and or how that role is changing, with a particular emphasis on the shrinking of the community banking sector. We just learned, in fact, that since 2008, the number of community banks has dropped by 1/3, assets have dropped by 14%. The papers in this session cover a whole number of aspects of this issue of the shrinking community banking sector, including differences in small business lending between large and small banks, changes in small business lending, the role of distance and remote lending, and the role of non-bank and non-traditional lenders. So there's a lot here. Now, why do we care about this? I think the short answer is we care about this because we care about small business access to credit. The somewhat longer answer is community banks may be special. They may be the true relationship lender. Now, speaking as an ex-lender myself, every lender considers himself a relationship lender. But here we're talking about the true relationship lender that we've referred to earlier in the session. If so, the decline in community banking could lead to a funding gap for small businesses or an exacerbation of an existing funding gap. Thus, the papers in the session are associated with key policy questions. Are community banks indeed special? Has the decline in community banking led to a funding gap? Did the financial crisis exacerbate the financial funding gap? I would argue that one serious problem that researchers have in the U.S. is data. In fact, I would argue that we're playing with one hand tied behind our back. We are hindered, I believe, by the unexceptional nature of U.S. data, particularly relative to Europe, with respect to access to finance by small and mid-sized enterprises. So in Europe, for instance, we've had for a decade a bank survey like the one we just learned about in Central and Eastern Europe, covering almost 350 banks, that distinguishes between relationship and transaction-based banks. It's been conducted in 2 waves by the European Bank for Reconstruction and Development and the European Banking Center. It's called the BEPS-1 and the BEPS-2 data set. And I don't have time to talk about this paper, but a paper by Thorsten Beck and his colleagues coming out in one of our top 3 finance journals, the JFE, Journal of Financial Economics, just shows how valuable this kind of data set is. The good news here is the survey that Lee just introduced us to is filling this gap. So that's the good news. But beyond that, when we talk about the kind of data we have to answer these questions about small business access to finance in Europe, most European countries, certainly many of the European countries, have credit registries. And they require that all businesses, including small businesses, post their financial statements, typically on an annual basis. So Spain is a great place to look at access to finance because of this data. These credit registries have information on all loans from all banks and information on loan applications. In addition, there is extensive firm-level survey data in Europe, and there are a variety of different surveys. Probably the most expansive And the most informative about this financial crisis is the Eurozone's SAFE survey conducted by the European Central Bank and the European Commission. This is a biannual survey with information on individual firms, a survey of firms, their demand for credit, credit outcomes, very similar to the survey of small business finance that was unfortunately discontinued in 2007. And this survey starts from the beginning of the financial crisis in the Eurozone countries. So together, these European data allow researchers in Europe to identify demand versus supply, identify non-bank sources of finance, identify relationship banks, and control for firm-level characteristics, something that's very difficult to do in the United States. Now, the good news is we have very creative researchers in the United States, and we've seen the outcome in the papers in this session. That is, despite these limitations, these papers in this session offer important insights into the changing role of community banking, including that small banks focus more intensely on relationship lending. I would say the evidence on the difference between small and large banks in the survey is a little bit more nuanced. It's quite interesting. I encourage you to get granularly into that study. We also learned in this session about post-crisis bank small business lending being depressed. This is a key result of this paper, along with new findings on the precipitous decline in small business lending during the crisis. We learned that post-crisis lending at large banks has disproportionately gone to large businesses, suggesting limits to large bank small business lending. We learned that bank M&As have caused a decline in small business lending in target counties. Key contribution here is this terrific identification strategy of the merger and acquisition event distinguishing between home and remote counties. And we also learned that remote lenders can play a powerful role in the SBA market associated with improved access to SBA finance. And I think also the importance of non-traditional small business lenders. If we take those first four results that I talked about, this is consistent with the loss of small business access to finance. And I would emphasize this is all post-crisis data, so these results are new in the academic literature. The last finding that I mentioned is consistent with mitigating external effects. Alan and I talked about external effects now nearly 20 years ago on a paper on merger and acquisitions in banking in the United States. But getting back to the data, what we're really interested in is the net effect. That is, of the shrinking of the small business credit, the community banking sector, has the net effect on access to finance to small business been negative? And this is very difficult to answer. And one of the reasons it's difficult to answer, and Jan didn't talk so much about this, is the call report data substantially underestimates small business lending, and there's a great section in the paper, in the survey on that. And arguably, it's even worse than that. So the 7A loan guarantee program that Nate talked about talks about maximum loans up to $5 million, and so when we look at the call report data, that's only loans up to $1 million. So we're missing a big chunk of what most of us would think would be the small business, including the SBA sector. This underestimation problem affects studies like the one Jalapa and the one Rebel talked about with respect to their call report findings. There's also the issue of the stock of loans used in all three empirical papers is an outcome of both supply and demand for credit, not just supply. This limits our ability to pin down supply effects. And finally, without firm-level data on all sources of finance, the results in these three empirical papers need to be viewed as suggestive about the negative effects of the shrinking community banking sector, but not definitive. And this needs to be viewed in the context of some changes in access to finance, particularly the emergence of credit unions and the deregulation of the asset side with respect to business lending in the credit union space and fintech. So I would argue what we're lacking in some sense in analyzing the ultimate question, which is what's happened to access to finance for small business, is we need to think about what I call lending channels. And this builds on the concept of lending technologies that Alan and I first talked about in our 2002 paper, where lending technology is simply a way of making a small business loan. More precisely, it's a combination of screening mechanism, contract structures, and monitoring strategies. A lending channel combines the concept of a lending technology with a type of financial institution or other non-financial institution that provides that particular lending technology. Now, this is not necessarily an exhaustive list of lending technologies. I think Alan has a slightly different list, but this is the list I'll use here, and these lending technologies, which are different ways to make loans, could be relationship lending, financial statement lending, where you've got audited financial statements that you can calculate informative ratios from, asset-based lending, factoring, equipment lending, leasing, real estate-based lending, small business credit scoring, crowdfunding, and trade credit. And I would say here, we could also think about something we might call credit multipliers that could boost the power of some of these lending technologies. The 7A SBA program, for instance, loan guarantee program, would be an example. Not so important in the United States. Another credit multiplier is securitization. Securitization of small business loans is much more significant in Europe than it is in the United States. I will say one thing about the survey, in that the survey looks at loan products and makes distinctions between products offered by large banks and small banks. I would say that doesn't quite capture the sense of lending technologies in the way I'm talking about, where lending technology isn't simply a loan product. And I'll illustrate this with an example. Relationship-based lending, based on soft information, versus asset-based lending, or financial statement lending in between. They all are associated with the product of lines of credit. But there's a world of difference between an unsecured line of credit in a relationship-based loan and a full-blown asset-based loan, where you have got availability against accounts receivable and inventory, providing the security for this line of credit, calculated on a daily basis, where you've got a cash collateral account into which the invoice payments go, and you've got a back office operation that handles the whole ABL platform, and you're conducting 4 or 5 field exams each year. Those are very, very different lending technologies. And now, getting to the concept of lending channels, here I take these lending technologies and then I associate them with the financial institutions that make up the U.S. landscape. Now, this is not necessarily an exhaustive list of what those institutions are, but it's pretty close. We're talking about large banks, small banks, credit unions, large commercial finance companies, small commercial finance companies, the internet, and corporations, those being associated with crowdfunding and trade credit. The green boxes here are lending channels. Each box is a lending channel. Each green box is a lending channel. And the key point is not all lending technologies are offered by all financial institutions. And what we're concerned about here is what has happened to the lending technologies that small banks have provided, given that the small banking sector has shrunk. And probably we're most concerned about the relationship lending technology, if indeed community banks are the true relationship lenders. And more specifically, we're concerned about this external effect. It may be the case that finance provided by the small business banking sector to small businesses the community banking sector to small businesses has indeed contracted, but if that's offset by an expansion by credit unions of credit, and it's offset by, say, crowdfunding or other channels like commercial finance companies, then the net effect may not be negative. Now, talks actually a fair amount about the emergence of credit unions and the deregulation that has allowed them now to make small business loans, but I don't believe that was included in your analysis. I won't mention, I've run out of time here, but I want to make, my main point here is that good firm level data, survey data like the data that we had in the small business, survey of small business finance that was discontinued, would help us significantly answer the question of what has happened to access, the net effect to access to small business finance, if that survey were constructed such that it included all of the different sources of finance. So in conclusion, these papers highlight and significantly deepen our understanding of the shrinking community banking sector. They tell us much about the impact of this phenomena on commercial bank small business lending, and in doing so, raise some significant policy issues. Nevertheless, the overall effect on small business access to finance because of this change in the size of the community banking sector, I think is still an unsettled issue, in part due to our data limitations in the US. So that's my discussion.